Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to go over overly optimistic and almost useless Zillow and a few of their articles. Now, remember, half of the nation only gets their housing market info from Zillow. So I think it's important to study what they're saying. So we'll go into that, you guys. But regardless, what we're going to find out is the housing market is slowly dying and almost completely dead. We will start seeing additional price cuts, additional supply, and median sales price continue to decline. And I suspect we will continue to see this happening for the next several years, so long as there's no more government bailout, which happened this year, March of 2023, which essentially kicked the can down the road, and we have to pay for that. So hopefully that will not happen. But don't forget, you guys, I'm not a financial advisor, even though my bio is as a realtor, loan officer, and instructor in real estate, so I know a little bit about it. And if you can, please like this video and subscribe if you haven't already, and shoot me a comment below. And if you can, hit notifications and share the video. Now, the name of this article is Fall Housing Market Outlook, Cooling Quickly. The seasonal cool down for the housing market is shaping up to be extra chilly this fall, swinging negotiating power towards buyers. Thank goodness. Few bullet points. Competition in the housing market is cooling off remarkably fast, even this time of year, and sellers are cutting list prices more often than any time except last year. The fall might be a sweet spot for home buyers who have room in their budgets to deal with higher mortgage rates. The housing market always cools off gradually from midsummer until the holiday season. But this year, that cool down is accelerating, thank goodness, at an unusual pace for early autumn. That means the balance of negotiating power is swinging rapidly from sellers to buyers. It is also likely a precursor to slowing home value growth, or rather negative equity decline, and even some price declines this fall and winter. So this time they're preparing for it. Unlike last year, they kept their heads in the sand all year last year, and finally they're starting to say, actually, there's probably going to be some price decline. And actually there already is price decline. Literally right now there's price decline. That is beating seasonality. Sellers keep cutting. The weekly share of listings with price cuts climbed in late summer all the way, oh my gosh, all the way up to 9.2% in the week ending September 16th. That's crazy. That's a lot higher than what Redfin is saying. Redfin is saying 6.5% on a 1 month average. The weeks after Labor Day often set a high watermark for this metric, as sellers get anxious that they missed the summer tide of demand and try to revive interest with price cut before demand slips further away. And that's exactly what's happening. Demand is not only going to slip further away, it's going to be destroyed permanently for some people. But even for this time of year, 9.2% is quite high. The comparable week in 2019 saw 7.9% of listings with price cuts, which itself was unusually high. So this is a record high. I mean, this is crazy. This is going to happen right before our eyes. Here's the weekly share of listings with price cuts right here. There's a drop down if you want to see your own metro area. So here's where we're at right here. Very interesting that it's saying that this time last year was actually at 10.8. Again, Redfin is completely different. I don't know why it's such a huge difference, but it is close to last year, according to Zillow. Again, according to Redfin, it's exceeding last year. But this is where we're at. We're sitting at 9.2%. Hopefully this gets over last year's highs. Again, according to Redfin, it already has. The new listing drought has modestly improved since July of 2022. The flow of new listings trended almost continuously toward ever deeper seasonal lows. But this August saw an unusual month-over-month increase in new listings. And do you guys think that the reason we're seeing an increase in new listings is because not only are there buyers on the sidelines, but there's also sellers on the sidelines on top of the quantitative tightening. So we're getting more inventory from institutional investors, from REITs, from the STR market, the long-term rental market, and as always, from distressed sellers. And people are like, where's the forced sellers? We have forced sellers every single year. In fact, right now, minimum of the active listings, 30% of the active listings are already forced sellers. Now take a look at this. This is weekly new listings. I love it. Basically, we've been plateaued pretty much all year. I want to see this go up. In fact, we need to see this go up, and look at the trajectory here. The trajectory, now this is a percentage increase. Basically, it's showing we're 10.3% off year over year. Again, Redfin has 15%, Zillow saying 10%. Very strange, the huge differences here. But nevertheless, it's shooting up. So hopefully that will shoot up over the 0% mark. It probably is. I mean, it's skyrocketing up. Keep your eyes on there. Again, this has to drop down if you want to kind of monitor your own metro area, or if your metro is not on here, one that is on here. So this is Zillow. Why is this happening? Why is the housing market collapsing? Let's see what they have to say. The most likely cause for the late summer pullback in demand is the same force that's been in the driver's seat for well over a year now. Is it prices? Are they going to say prices? Nope, they're not going to say prices. They're going to say mortgage interest rates, because they're no better than used car salesmen. They climbed higher in August, and 30-year fixed rates have sat above 7% for 6 weeks running, further discouraging homebuyers right as many step away from house hunting to buckle down for back to school and holiday planning. Last year, rates only crest 7% for a couple weeks on either side of Halloween. And unfortunately, all indicators point towards rates staying higher for the near term. So if you were one of the people that were promised just buy now and refinance later, sorry, that was a lie the whole time, because you need to qualify to refinance, and you need to be able to qualify for a lower rate than you already have. The Federal Reserve's forecast and language at the September meeting of the Federal Open Market Committee sent markets a message that interest rates will be higher for longer, pushing 10-year Treasury yields, which mortgage rates tend to follow, to their highest levels in 16 years. This goes on, but why have sellers rushed in? To start, the uptick in new listings last month was more of a pulse than a wave. Maybe. It may be that some homeowners on the fence about selling this year decided to take the plunge after seeing the surprisingly strong sales posted earlier this summer. So again, sellers are starting to get off the sidelines. Why? Forced selling. What's forced selling? Maybe they can't afford to be homeowners. Maybe they need the liquidity. It happens all the time. Why? It's crazy that people are surprised about this. It could also be that some folks who opted to delay selling simply can't wait any longer. Let's talk about the forced selling. Life happens: marriage, divorce, new babies, new jobs. And for many households experiencing those events, they need to move sooner or later. So according to Zillow, what's next? Fewer bidding wars and more uncertainty on new listings going down. There's more certainty on listings going up. The share of homes that sold for more than their final list price has been gradually declining. Thank goodness. From a peak of 41.9% of closed sales in the week ending June 24th to 38.3% in the week ending August 12th. If the rising share of price cuts serves as a sign of changing tides in the market, it's safe to expect fewer of these above list price sales in the weeks ahead. Last winter, we observed that higher interest rates seem to discourage sellers as much or more than buyers. That pattern finally broke August and September, but it's too soon to tell if yet higher interest rates this fall will send sellers back into hibernation until springtime. I don't think that's going to happen. I think they're going to be sent into hibernation for the next 3 to 4 years, because that's how broken the housing market is right now, and that's how long it takes for a proper rebalancing. Now, according to Zillow, what does all this mean? For determined buyers with enough budget, and hopefully you've been listening to me and increasing your purchasing power, with enough budget room to accommodate the recent jump in mortgage rates, this fall is looking more and more like a sweet spot. But they're not talking about price. Again, they're not talking about price. There are more motivated sellers and more active listings overall than any time since last December, improving buyers' chance to find the right fit. That favorable supply setup is coinciding with a negative shock to demand, which means less competition for those home shoppers who remain in the hunt. This concludes. Sellers this fall may rule their timing as this summer's surprisingly favorable selling conditions fade into memory along with their summer freckles. Or rather, it was just a dead cat bounce or a suckers rally. Rather, one last ditch effort to profit off of the backs of consumers that ultimately they really can't afford these prices. But even without the benefit of a time machine, it's still possible to list in prime home shopping season for those sellers with the privilege of patience. Not the home buyers, huh? The next one will be kicking out in just about 5 months when we will share another update on the spring's shopping season's outlook. Like last year's report that gave an early alert about competitive heat returning to the market. So I see Zillow starting to be a little bit more dovish, a little bit more conservative, but they don't have it in their nature not to be bullish. So I'm still reading this as a bit bullish, but I'm also seeing it as they have no choice but to be more and more honest about what's going on in the housing market. And hopefully they will continue to do that, because the reality is at the end of the day, we're in a housing market right now that requires overwhelming caution to everyday consumers. We're not talking about filthy rich investors that have $50 million that can easily throw money here and there. I'm talking to normal consumers like myself. I'm a normal consumer. So what I'm doing right now, again, I'm increasing my purchasing power by improving my credit, my income, and my assets. I understand what my goals are, so I know what I'm looking for in a house. I know my price point. I know what I want in a deal, and I know where I want to find that house. So when I find it, I don't care if it's tomorrow, and I don't care if it's a year from now. Well, I prefer it's tomorrow, but I know what I'm looking for, and I'm already qualified to purchase it. I already have my loan approval, so I can buy tomorrow. I could buy today if I want. But the biggest thing of all is being patient and having the right mindset, understanding market trends, understanding the cycle. Now, other than that, guys, if you're out there investing in real estate, you know I wish you luck, and I hope you win.